Weekly wrap up. Who are you going to call? Ken the FX Freak. Ken, the Trump headlines have continued. How have the markets reacted to the sacking of Rex Tillerson?
So Trump is causing all sorts of dramas at the moment in the markets. Seems to be in every US headline from what we can see. In the latest anyway, Trump did announce a sacking of his Secretary of State Tillerson. He did that via his Twitter account, as he used to likes to post his views and latest news coming from the White House via that account. You'd never be able to take that away from him. It'd be like taking candy from a baby. Anyway, back to the topic. Tillerson was sacked, and the reason for that, they did share different views quite a lot in terms of clashing between Donald Trump and Tillerson. But the main thing came after Tillerson actually backed the UK, and the UK actually pressing for action against Russia. They say that the Kremlin used a nerve agent, the poisoning, the chemical poisoning, to kill the Russian spy, which was on British soil. So Tillerson did back the UK and its cause against Russia for that, and that's something that sort of Trump wasn't happy about. Tillerson going behind his back and doing that. So he did actually sack him, and he's now appointed a CIA director as his replacement to occur at the end of this month. But what that caused in the markets is instability. We did see the dollar weakening across the board, losing some ground against some of its peers on that initial announcement, because it came as well after only the last week where Trump sacked his senior economic advisor, Cohen, and that was for their disagreements on the trade tariffs. So it just shows that markets do not like uncertainty, and more of this could be coming because from various reports doing the rounds that Trump could be clearing out a few more from people that are around him in terms of his advisors, etc. So do be wary of that. Something that is very likely to dictate the dollar going forward.
Inflation in the US is being closely watched as the markets look for the next clues on a possible Fed hike. What did this report show?
If we look at the latest report for inflation, then it did inch up very, very marginally and at a much slower pace in comparison to that of what we saw in January. So inflation continues to remain stubbornly subdued. And if we look, just a quick recap, at the back end of January to early February, we did actually see a massive sell-off in stocks across the board. And that was sparked by investors' worries because wage pressures were to the upside. They were growing quite strongly. And people were worried that was going to feed through and drive inflation higher and seeing prices really creeping up at quite some pace. But in the latest report that we saw this month for wages, they actually cooled, so that eased some concerns. But remember, guys, markets are expecting at least 3 to 4 hikes from the Federal Reserve this year. But remember, the Federal Reserve need to keep in mind inflation, because if they go and raise too fast, they're going to have a problem of deflation on their hands, because if we look at the levels at the moment, they're still too low. So for me, I believe as the year goes on, markets will become quite impatient and the Federal Reserve are not moving fast enough with meeting their expectations. So this could, in fact, weigh on the dollar. Once again, remember at the start of this year, we saw the dollar underperforming against some of the major peers. And I think that could, again, have an impact on the dollar as markets become growingly impatient with the Federal Reserve.
Finally, oil prices have come under pressure. What are the key drivers for this?
So for oil, the key theme here is glut. Glut. There's so much oversupply, a lot of barrels, but not enough demand, and oil prices are falling quite heavily across the board, as we've seen in the last few weeks. And it comes after as well OPEC released their monthly oil report, which actually showed, if we look at the non-OPEC members, they're expecting their output and supply to almost double in comparison to their forecast back in November, which is concerning because remember, the OPEC agreed, a cut in production, but if the non-OPEC members are continuing to produce, those cuts are pretty much going to be redundant within the oil market. So that's something that has weighed on the oil prices across the board. And then secondly as well, OPEC saying that they need to achieve really 33 million barrels per day in terms of demand in order to try and get rid of some of this oversupply. But they're really not seeing that at the moment. Particularly if we look at the US, obviously they're a non-OPEC member, but they are just supplying so much oil in the market. It's just over polluting it, and there just isn't the demand there for the time being. It really isn't there. So oil prices are consequently suffering on the oversupply and not enough demand. Simple economics there.
Thank you, Ken. It was lovely speaking to you as always. Well, a big thanks to Ken, and thank you for watching. If you like this and would like to find out more, be sure to head over to dukascopy.tv.